Welcome to Equity Builders and welcome to episode 7 of the weekly Watchlist. Today we got two companies who have actually been surging through this pandemic that's been going on here over the past few months. And we're going to start off with a simple one you hear all about, Microsoft. And it's just one of those companies that's always around. You know about it and you don't really have to worry about it. So it's going to start us off and let you know why we think it's a good buy.
Yeah, guys. So with Microsoft, right? Everybody knows what this is. Everybody's used a Microsoft product before at some point in their life, right? The reason we're bringing Microsoft stock up is because, as you can see on my screen, they've kind of stalled out. They're at the $205 mark. They're kind of floating around $200 for a while, but we think that this is just the beginning of a long bull run for Microsoft. So the reason that we're bringing this company up is they have a terrific balance sheet. $136 billion of cash and cash equivalents in the short term, ready to just pull the trigger on anything they find attractive. As we've seen, their management team is spectacular. They know how to work business deals. They know how to manage their money really well. If they think something is a true win, guys, they're going to pull the trigger on it. As we've seen with the TikTok deal that was alleged to happen, it didn't go through, unfortunately, or fortunately, depending on how you look at that. Maybe they didn't see something in TikTok, but one thing you can always bank on with Microsoft is that if they're not completely comfortable with the deal, and if the deal completely isn't in their favor, they're not going to make it. And that should make you feel really good as an investor, guys. That's just some of the reasons so far that we think Microsoft could be an interesting play for you.
Exactly. And with that, Microsoft already has multiple revenue streams. So they have cloud, they have Microsoft Office, which every company pretty much ever uses.
Yeah.
Like an Excel spreadsheet is the basis for 99% of companies, especially in the US. But aside from that, they're huge in the gaming industry, obviously with the Xboxes. And then they have other areas of revenue that are smaller, some bigger, some growing, things like that. But it's always consistent. That's always what you're going to get with Microsoft. It's always consistent. So what we have with the new Xbox, which people are very excited about, obviously, the next gen models and all of those things. But they have different products that go along with it. It's not just the Xbox. They're going to be selling different hard drives. They're going to be selling different controllers, different remotes. You're going to have all these extra little things. So something you see with Apple is you buy the computer and it doesn't come with all the adapters, So you have to buy a special adapter for it. If something breaks, you have to buy a specific Apple product for it. Xbox and Microsoft do a similar thing. You need a specific controller. You need a specific SSD card for your hard drive. It's just little things like that. They follow the same business model. And obviously, when you think of success for a company, Apple and Microsoft are two of those that are always brought up.
Yep.
With the gaming industry, Microsoft has an acquisition of say that for me, Vasily.
Bethesda.
Obviously, I know the company. I'm just not the brightest, can't read, but I'm good with numbers, so that's all that matters. But this is very damaging to Sony because it's such a huge company. It has a lot of games that are very popular.
Yep.
They always bring in numbers. Different things like Skyrim. That's just a game that I've known growing up. That's been around for say 15 years, and they're supposed to release something new on the next gen, and everyone is very excited about that because that game has been played for 15 years, continuously.
Yeah.
And they're making a new edition with that. They also have different subscriptions to the Xbox, so they have Xbox Live, so it's like $10 a month. So not only do you have to buy the Xbox, but you got to pay $10 a month or $60 a year. So they're always bringing in money through that. That's like every console brings in that extra little bit of revenue every month. Of course, they're bringing in different. It's just it helps with the balance sheet. Just that extra revenue. That's one of those extra revenues we were talking about earlier. So those little things that so many users build so much extra revenue that some companies only have that. They only have that $10 a month. Yeah. And Microsoft just brings it in casually. It's not a big deal. That's just something extra for us. But aside from that, especially with Xbox, you're seeing a lot of growth, especially right now. But it it holds their balance sheet to a certain standard, and it helps them keep their long-term debt very low.
Yeah, which is really important for a company of this size to have such a terrific balance sheet. They're not really in any danger at all. So, moving forward, let's talk a little bit about some of the metrics that everybody likes to talk about, right? Graphs, dividends, stuff like that. As you can see, starting off, our payout ratio is super low down there. It's like in the 30% range, so the dividend is going to be able to keep growing. Let me just shoot you straight, guys. This is one of the best dividend/growth companies you're going to get. As you can see, the 52-week performance here, we got about a percent gain a week, 52% gain. So it's gonna keep along the same trajectory. Obviously, the analyst opinions don't really matter to us, but they got a neutral opinion, some green, some neutral. The graph looks really enticing here, though, guys. So as you can see, it's stalling out. We think it's going to keep going in the upward direction over a long period of time. But what's great about this is usually when you see a graph like this, you're not going to get this little 1% dividend down here that I'm showing you. You're going to get usually nothing because most growth companies don't offer a dividend. So this can be a really good way to kind of win on both ends, like stock appreciation, and you're getting paid out, every quarter, just a little over 1%, which is very nice. As I mentioned before, with the company's strong balance sheet, you're going to get a super stable dividend, and their dividend continues to grow year after year. So not only are you getting stock price appreciation, you're going to get dividend appreciation, meaning that 1.06% could turn into like 1.07, or they might just give you more money if the stock price appreciates. You know what I mean? Like, this company's really good about returning value to its shareholders, and we've seen them do this multiple times through dividends, through share buybacks, which they're usually very aggressive on as well because they produce so much money, guys. They're just good at making money. Like, this company is ridiculous, okay? Let's talk about market volatility. Is this company really affected? I don't think so. As we've seen this year, right? Prime example. Huge market crash. Where did Microsoft go? They went down for a second, but then they ended up hitting new 52-week highs, guys. Like, they're not affected at all. Like, this company does not care what you think. It does not care what you're doing. They're going to keep going up. So, with the release of the new products that were mentioned earlier by Tyson, we're going to see this company continue to hit new 52-week highs. They're going to keep creating new ways to make revenue, and they're just innovators, guys, in their own space, right? They're just the best player in that space, and it is what it is.
Yeah, exactly. And with that, they've continuously outperformed the NASDAQ and the S&P 500, which is huge. So, like, your basic investors, like people that don't really pay attention to the stock market, they put their money in there, not a big deal. They'll see some sort of growth over the next 10, 15 years. But you can increase that growth and have it a lot faster with a company like Microsoft, which is good for your portfolio, especially if you're starting out. Not to mention that their earnings per share grew 22% from 2018 to 2019. And their net income doubled that. So that's something that you don't see very often. And with that, you're probably going to see that for years to come, just because of how the company is ran. It's really just about how they do things. The space that they take, they have the gaming space. They have literally companies that use their product every single day. And it's not like they're going anywhere. You know what I mean? So with that, we're going to get into another company that we believe is a lot different, obviously, but it has that similar thing where they're thriving right now, while a lot of other companies aren't. And we think that there's more to that. It's not just about the right time, right place, but there's a lot more to that.
All right, guys, and the next company is Lowe's. You might be thinking, what in the world are we thinking on this one? Yes, we're talking about the place that you hate to go when your dad needs paint for the living room, all right? They're getting serious about their stock price, all right? They mean business. Ever since Lowe's has decided that they want to become an online presence in the home improvement space, they have seen a 135% growth in their online traffic, okay? That is huge, all right? Home Depot better be shook because they are coming, all right? They mean business. In 2019, Lowe's posted up $72 billion in sales, which is a 34% increase from that time to fiscal year 2020 in the second quarter. All right. Second quarter was huge for Lowe's, obviously, as I just said. Huge for Home Depot as well. But Lowe's is closing the gap, guys. So as I mentioned that, Tyson's going to give you a little bit of why we think Lowe's could take advantage of this.
Exactly. So right now we're not only in a recession, but we're also in a lumber shortage. So you'd think that Lowe's, a company that makes a lot of money off of selling wood for home improvement, would be struggling right now, but they're actually growing. So lumber is a top 3 revenue for Lowe's. So obviously it brings in a lot of money, but it also brings in a lot of money through appliances and then their seasonal outdoor department. So they have those top 3, and then their other departments honestly aren't that far behind them. So they got paint, they got different things like that. But with the turbulent market, like with the recent crash, they've had stability, and this is a good thing for investors because it can keep us confident and it keeps them confident. It's kind of it gives it both ways. It makes them feel good that their investors believe in them, and we can believe in Lowe's because they're growing in a time where they shouldn't be. And that's something to say about the company itself. The CEO believes in always paying their dividends to investors and wants to be not only a competitor but a leader in their market. So obviously Home Depot is a big competitor. They've been ahead for a long time, but Lowe's is definitely closing in, and we believe that it's going to surpass that because of the way that the company drives sales.
Yeah, and I mean, like I said, guys, they're getting serious. And what I mean by that, as he mentioned, stability, right? Their dividend is stable too, guys. They're not just playing around with this new support level on their stock price or anything. Their dividend is pretty safe, and they offer a pretty good one at that. So if we go down here and look at it, 1.42%. For a double-digit gaining stock, like for a stock that gains in price double digits for the past couple years, that's pretty good, guys. You really can't complain there. This is another one of those dividend growth plays that usually gets overlooked, okay? And the reason that we think Lowe's is a really good buy is because it's not getting that traditional stock market hype. Who the heck wants to say they own Lowe's, okay? It might be boring. It might sound boring, but it's not going to hurt your wallet. It's going to help it a lot. So, I mean, other things to take into account. They've stated in numerous earnings calls that even if revenues were to decrease, they would not cut back on dividends. So, with my point earlier, I said they're stable, right? If we have a huge market crash, and they've already said this on an earnings call, your dividend ain't going anywhere. How bad would that be for them to go back on their word, guys? If they've given you their word, and Lowe's management really has proven to be successful with this 56% gain, 52 weeks since the last gain, right? They're not going to go back on their word. Your dividend's not going to get cut. It's pretty safe. So with that being said, I mean, there's some other factors in there too, but I would sleep well at night with Lowe's in my portfolio.
Absolutely. And with that, they said that if revenues were to increase, they want to increase their dividend with that. So not only are you looking at a triple-digit number for a stock that you're getting over 1% on your dividend, they want to increase that as they grow. They want you to grow with them. And that's really cool to see from a company that they're open to talking about how they feel about their customers, their investors, different things like that, and that they want not only for the company to grow, but for everyone to do the same. That's just something that I like personally about the company. But they're definitely closing in that gap on Home Depot, like we said earlier. And we're seeing some stock appreciation. As soon as they pass Home Depot, that number is going to continue to grow at a higher rate. And that's just how it works. Whenever you surpass competition, normally word travels a lot faster, and people start to put their money in
The
different
hype
things
builds.
like that. Exactly. When Tesla became big and everyone realized that they're going to make more, like everyone started to think that they were going to make more money than those traditional motor companies in the U.S., the stock price went to the top.
Yeah.
And we're not saying that it's going to grow like Tesla. I'm not going to give you that false
probably
hope,
not.
But we are going to see more growth as they continue to close that gap and surpass them. And not to mention that they're trading right now at a price to earnings ratio of 21. So this is kind of a value buy here. And when you have a value buy for a growth and dividend stock, there's really nothing you can go wrong about that.
Yeah, guys, and honestly, when we keep bringing up Home Depot, let's just give you like a reference, right? So when doing my research, Home Depot has a little under 2,300 retail stores. But Home Depot has something that Lowe's doesn't already established, which is an online presence. Lowe's is boasting 2,200 retail stores and is slightly behind Home Depot. If you recall, I told you that Lowe's just started caring about their online presence. This could be huge, okay? They could honestly build up their business bigger than Home Depot if they add a few more retail stores and really get that online traffic, guys. This could be a huge shift in home improvement. It's not the most sexy thing to talk about, no, but they could really do it. They could really pass Home Depot, and this could be a double-digit gainer for years to come, guys. So that's our case on Lowe's and why we think that Lowe's could be a potential good buy moving forward. With that being said, as you guys know, we're not financial advisors. Do your own research. This is entertainment purposes only. Just take our opinions with a grain of salt. Anything else you want to say?
Not really. Just like, comment, and subscribe.
See you guys next time.